Hi, this is Ravi. In this video, we would be looking at a futures and options trade we took last month and made about 15% with respect to the capital employed. In this video, we would be looking at an actual position trade that we took on April 9th and closed on April 30th, 2020. But let's first learn the difference between intraday trading and delivery position trading. In intraday trading, traders typically do not keep any positions overnight, whereas in delivery trading, traders do not limit themselves to same day trades. While intraday traders mostly rely on technical analysis, delivery traders rely on both fundamental and technical analysis. Both methods have their advantages and disadvantages. Our style of trading comes under delivery trading and involves higher margin commitments. So if you are someone with less capital, then this video is not for you. Now back to the strategy. This is a risk defined strategy. That is, we know what percentage of our capital is at risk before entering the trade. There is no way you can lose more than what is initially calculated if we strictly follow the set out rules. Our strategy is known as a collar in the trading world. While in a collar, the call and put options are both out of the money and have the same expiry date. Here we have a longer dated deep in the money put and a shorter dated call. Let's look at the actual trade. On April 9th, we entered the following trade. Buy one lot of Nifty June futures at 9054.05. Sell one lot of Nifty 16th April 10,000 CE at 12.8. Buy one lot of Nifty December 10,000 PE at 1379.15. Let's look at the risk involved. Maximum loss at expiry is equal to futures purchase price plus premium paid for the long put minus long put option strike price into lot size, which comes to about rupees 32,490. So the maximum we can lose in this trade is rupees 32,490. As only the near month, next month and far month futures contracts were available for trading at the time of our entry into the trade, we chose the June contract. In case we do not meet our profit target by June end, we would roll out the future to another 3 months. On April 15th, we bought to close the 16th April 10,000 call option for 1.4 and opened a 2:1 call ratio spread as follows. Sell 2 lots of Nifty 23rd April 9900 CE at 40.6. Buy 1 lot of Nifty 23rd April 10,000 CE at 29.7. While ideally we are supposed to sell 2 lots of 23rd April 10,100 CE, we took some risk and sold 2 lots of 23rd April 9900 CE as we expected Nifty to move in the 8800 9400 range. In the subsequent week, that is on April 20th, we bought to close the two 23rd April 9900 call options for 5.7 and sold to close the 23rd April 10,000 call option for 4. We also opened a new 2:1 call spread ratio spread as follows. Sell 2 lots of Nifty April 10,000 call at 34.5. Buy 1 lot of Nifty April 10,100 call at 24. On April 30th, we bought to close the two April 10,000 call options for 1 and sold to close the April 10,100 call option for 0.8. We also sold to close the December 10,000 put option for 780 and sold to close the June futures for 9849.88, thereby closing the entire trade for a handsome profit. We sell weekly call options to compensate for theta decay in the long put option. Out of the money weekly put options though should not be sold as this would increase the risk in case Nifty drops considerably. Taking the commissions and other adjustments into consideration, we made a handsome profit of Rs 21,694.77 in this trade. The capital did not exceed Rs 1.5 lakh at any point of time in the trade. So the profit comes out to be about 15%, which is pretty good, as we were in the trade for just under 3 weeks. As with any good strategy, these are some rules that we have to follow. The expiration date of the long put option should be about 3 months or more and should be about 10% in the money. That is, if Nifty is at 9100, the long put option should be bought at 9100 plus 910, which comes to approximately 10,000. Usually, options with a higher open interest should be bought as the bid-ask spread would not be wide in such options and would be easier to enter. Always try to enter at the midpoint of the bid-ask spread. Also, strike prices at round numbers such as 8,000, 8,500, 9,000, 10,000 tend to have higher open interest and thus provide more liquidity. Continuing with the rules, Weekly call options should be sold only at or above the strike price of the long put option. Weekly out of the money put option should never be sold. When a 2:1 call spread option is entered, it should usually be buy one option at a lower strike price and sell two options at a higher strike price, ideally at the strike price of the long put option. This rule, when not followed correctly, can increase the risk significantly, which is not something we want. Although we ended up in profit both times we floated this rule, it is not recommended you do the same. Thank you all for watching. Also, please don't forget to like this video and subscribe to this channel.